I'm going to start today with a chart of Bitcoin. What a story over the weekend. Started Saturday morning about 8 a.m. and went on for about four and a half hours. Price just slid. Closed 83,000 on Friday. We're sitting at 78.5, down 5.37%. I find it interesting. I put this chart up and the comment I have right on the very side here. Bitcoin tried to break above 85,000 level but failed. It's now back into a high demand zone. As long as the $80,000 level is not lost, Bitcoin has a decent chance of bounce back here. And we're below the 80. You would think that the algorithm would take that comment and say, well, that's not an appropriate comment for what we have on the screen, is it? Anyways, this sort of is a continuation of what we saw on Friday, which was rightfully called a liquidation. And these things happen when risk events change. It's called a risk-off liquidation. And we saw it in metals, so we're going to take a closer look at metals and sort of ask the question, is there any opportunity in trying to catch a falling knife here? Is this a falling knife, or was this just a correction back to a longer-term uptrend, which I think is still in place? We'll have a look at that. And of course, what caused all of this? It was the announcement of Kevin Warsh as the new Fed chair. And you've heard some good things about him, I'm sure, and some bad things. Oh, he's been a lifelong hawk. So rather than just take everybody's word for it on the podcast, I thought I'd do a little deep dive on Kevin Warsh myself. And I spent all day Saturday watching a whole bunch of interviews of his that were online, and I got a good feeling for why he's being called an inflation hawk. And he's not being called an inflation hawk over the level of the interest rate, but over the level of the balance sheet. And I have to agree with him on that part. So we're gonna just do a little bit of a deeper look at him. But first, let's revisit Deepthink. I asked Deepthink 5-6 months ago. I think some of you may remember. I asked Deepthink to forecast who the new Fed chair would be. And what I have on the screen is the forecast. Bessent's likely recommendation, Kevin Warsh. Trump's most likely selection, Kevin Warsh. So Deepthink was right on this one. So I asked Deepthink a follow-up question. I said, let's revisit this. It's January 31st, 2026. Trump has announced that Kevin Warsh will be Fed chair. You got it right. Now let's forecast what he is likely to do as Fed chair beginning May 15, 2026. Also try to incorporate if Jerome Powell will remain as governor. What is his upside given his accomplishments at his age? A lack of another seat could complicate Warsh's plans. Forecast the likely path of Fed funds, the likely path of the size of the balance sheet, and the likely mix of U.S. Treasury versus the current $2.2 trillion of MBS. Give me a timeline on your forecast for the end of 2026, end of 2027, and longer term. And he starts off with Powell right away, and this is what I've been saying for some time. He's not going to stay. There is no upside for him staying, only downside. He's going to take his exit. He's won. His legacy and his reputation are intact. He engineered a soft landing out of the worst downturn, a global shutdown, and 9% inflation. There is no more winning left here for this guy. The fate of Jerome Powell, a dignified exit. When I saw that, I thought, yeah, that's as far as I need to read. He will resign from the Board of Governors effective May 15th, 2026, coinciding with the end of his chairmanship. Zero upside reality. Powell is an institutionalist who prioritizes the Fed's reputation. Remaining on the board as a backbencher until his term expires in January 2028 would be untenable. It would create a rival power center, confusing markets and forcing him to constantly dissent against the new regime. To preserve his legacy as the architect of the post-COVID soft landing, he will choose a graceful departure over political obstruction. The strategic second seat, his resignation is a strategic necessity for the Trump administration, opens a second vacancy on the board, in addition to the seat Warsh fills. allows President Trump to appoint another loyalist like a supply side or housing economist, granting Warsh a reliable voting majority to override the career staff and regional presidents who may resist his radical changes. That would give Trump 4 of the 7 governors. There's your majority. Let's look at Warsh. Sort of predictable, I think. Monetary barbell, dovish on rates, hawkish on the balance sheet. He will cut rates aggressively, arguing that the supply side boom from Trump's deregulation allows the economy to run hotter without inflation. I agree with that statement. When you tell me, GDP is running 5%, well, that means there's more output. If there's more output, that is actually a downward pressure on prices. Hawkish on the balance sheet. He will ruthlessly attack the bloated Fed balance sheet, viewing it as a source of moral hazard and asset bubbles. I agree with him there. Fed holding $7 trillion of securities. He wants to bring it down to 4. At least that's what we've heard in other sources. That's $3 trillion of money floating around in the economy instead of being held by Treasury. So if they reduce it by $3 trillion, somebody somewhere has to hold it. You're taking $3 trillion out of the economy. Not only that, if you refuse to increase your balance sheet, you refuse to help finance government deficits. Now the government has to say, well, who's going to lend us the money? If we introduce more debt into the market, we risk the long end of the curve going up even more. So it may force them to be a little bit more or a little bit less profligate. We'll find out. But imagine what the economy, the financial markets are going to be like if you have to remove $3 trillion of liquidity from the markets. Maybe Bitcoin is showing us how metals will continue to open on Sunday night. Let's see what we have here. This was interesting. The Treasury Fed Accord. The central conflict of Warsh's tenure is that he wants to sell mortgage-backed securities to purify the Fed, but doing so would spike mortgage rates, which Trump opposes. The solution, the swap. Warsh and Treasury Secretary Scott Bessent will execute a historic asset swap. The Fed will exchange its MBS holdings with the Treasury for T-bills. The result, the Treasury absorbs the housing debt, effectively moving it to the fiscal books, and the Fed is left with a clean Treasuries-only balance sheet, allows Warsh to exit the housing market without crushing it. Federal funds rate path. Warsh will abandon data dependence for a strategy-based approach, arguing that real rates are too restrictive for a productivity-led economy. May 15th, Warsh signals an immediate pivot. End of 2026, 3 to 3.25. I saw that and I thought, but that's what Powell is predicting. And I did push back on Deepthink shortly about this, and we'll see how Deepthink responds. I gendered it. I called Deepthink he. 3 to 3.25. Aggressive cuts 100 to 125 basis points. So the math doesn't add up because we're already 3.5 to 3.75. AI is not perfect, right? Warsh frames this as normalizing rates to support the administration's industrial policy. End of 2027, 2.5. Maybe that's where it's getting the 100 to 125. If you're going from 3.5 to 3.75 down to 2.5, maybe it's including the 125 and all of that. End of 27, 2.5. Cutting cycle concludes. Warsh establishes 2.5 as a new long-term neutral rate. Long-term 2.25 to 2.5. Warsh resists raising rates even if growth accelerates, provided commodity prices remain stable. And I had to push back here as well, is that if he's unwilling to raise rates if the economy runs hot, is he also unwilling to lower rates if the economy slows down? Is it symmetric? Balance sheet and asset mix. Now, this is Deepthink's forecast. I just want to remind you of that while we're going through it. Deepthink was absolutely right about Warsh 5-6 months before Trump picked it. This is the most radical shift. Warsh aims to turn the Fed into a monoline central bank, government debt only. Balance sheet size end of 2026, $5.8 trillion. Accelerated runoff and swaps. Yeah, you're going to have to do some work to get it to $5.8 trillion by the end of the year. End of 2027, $5 trillion. Long term, $4 trillion, returning to a scarce reserves framework, from ample reserves to scarce reserves. Again, if the Fed is not holding $1,000 bond, that means somebody in the market must be holding $1,000 bond. That $1,000 is not available for asset pricing somewhere else. It's in the bond market. Asset mix, MBS versus Treasuries. Current 65% Treasuries, 35% MBS. End of 2026, 90% Treasuries, 10% MBS. The swap is in full effect. End of 2027, 100% Treasuries. The Fed exits the housing market. So this is a sort of a summary here. The outcome by the end of 2027, the Federal Reserve will look radically different. It'll have low rates, satisfying Trump, but a pristine, smaller balance sheet, satisfying Warsh's sound money principle. We're going to see on the next screen when I talk about a little bit of his background. He was actually a Fed governor with Bernanke. He resigned in early 2011 over QE2, arguing that all you're doing is encouraging the government to spend more money, and this will be inflationary. He's a hawk not because of the low interest rates. He was a hawk because of the sheer size of the balance sheet. And he wants to get that down. He says if you get the balance sheet down and you pull that liquidity out of the market, you can have lower interest rates because you take away one of the big inflationary drivers on the demand side, which is government spending. We'll see if that's true. Could it be solved by that? I wonder. So I have a follow-on question here because I didn't agree with some of the output. Trump appointed Warsh, and Trump wants very low rates. It is probable, based on forward guidance, that 50 basis points of cuts would have occurred under Powell to get to the same 3 to 3.25 you are forecasting by the end of 2026 for Warsh. How is this any different of an outcome from a dependence perspective? Also, if you forecast that Warsh will shift to a strategy-based focus and not raise rates with increased economic activity, does that also mean he will not cut rates with decreased economic activity? Those should be, if you're paying attention, two obvious follow-up questions, right? The forecast analyzes the nuance of a Warsh Fed versus a Powell Fed, given similar terminal rate by late 2026. Even if the destination is the same, the journey and the reaction function are fundamentally different. The Warsh difference is not in the number, but in the conditions, the certainty, and the yield curve. Now, for those of you looking at ZQ, pay attention to that second word, the certainty. The primary difference is the burden of proof required to lower rates, the Powell path. Defensive data dependence. Logic, Powell subscribes to the traditional Phillips curve growth versus inflation trade-off. For Powell to cut to 3%, he needs the economy to slow down or inflation to be perfectly behaved. The constraint? If the Trump boom creates 4% GDP growth, or if tariffs cause a temporary inflation spike to 2.8, Powell would halt cuts or even hike, arguing the economy is overheating. The outcome under Powell, the market views 3% as a recession reward, a safety net deployed only because things are getting worse. The Warsh path, instead of defensive, is offensive. Warsh subscribes to supply-side theory. He argues that growth driven by deregulation and investment is disinflationary. More goods equal lower prices. Therefore, he does not need weakness to justify cuts. Warsh cuts to 3% even if the economy is booming. He frames it as normalizing rates to support capital formation. The tariff factor. This is the critical differentiator. If tariff spikes CPI, Warsh will argue it is a one-time price level adjustment and look through it, refusing to hike. The outcome, under Warsh, the market views 3% as a growth multiplier. Fuel poured on a fire that is already burning. So the market is probably going to start pricing in the 3% because it would lean to the certainty of 3%, but under Powell, it's, well, we got to wait and see what the data says. Now, only the data will allow it. Warsh is saying, damn the data, we're going to 3%. We're going to do all our work on the balance sheet. Summary, Powell's 3% is a ceiling protected by inflation vigilance. Warsh's 3% is a floor supported by growth prioritization. And we did see on Friday, even with very hot PPI, if you were on the live that I do on Discord on Friday morning when PPI came out, you heard me say, this is not good, this is not good. It was a spike in PPI. But ZQ started pricing in basis point cuts during the day, which is a radical departure from what I've been trained to expect. That every time there's good news, it goes to the equity market, and ZQ just sits there. Every time there's bad news, the bond market gets it all. So I was expecting, oh God, here we go again with ZQ. Let's keep pricing out rate. And no, as soon as Warsh was announced, as soon as it became official, we got some basis points. Not many. I think four basis points, 5. But my position is so big, those 4 or 5 made my day. Okay, let's deal with the asymmetry. Heads I cut, tails I don't hike. You asked if he won't raise rates with increased activity. Does that mean he will not cut rates? No. Warsh's strategy is asymmetric, but with a specific catch regarding where he is what he is rescuing. Scenario A, the upside. He does not hike. He ignores the overheating signal that worry Powell, effectively removing the speed limit on the Trump economy. So even if there are no cuts, I know exactly what my downside to ZQ is, and I can handle the downside. So I have no reason to exit this position at this point. Warsh is going to provide, in his statements and his strategic shift, certainty that we're going to 3% by the end of the year. So there's the 2 cuts I need. I am in a no-lose situation on ZQ at this point. We could get more. Scenario B, the downside. Market correction or wobble. Reaction, he is stickier than Powell. Warsh has built a career criticizing the Fed put. If S&P drops 10% but the banking system is fine, Warsh will likely hold rates steady, arguing that cleansing excesses is healthy. He will not cut just to soothe stock traders. I don't think Powell was really like that either. It was in crisis that you had this Fed put. But we had a correction earlier this year with tariffs, and the Fed held all the way through it and didn't cut until September. And I thought they should have been cutting earlier, but didn't cut until September. So I don't know that is stickier than Powell, but okay. Scenario C, the crisis, credit crunch. Aggressive cuts. I love to hear that. Warsh is a liquidity hawk. While he ignores stock prices, he is obsessive about credit spreads and banking liquidity. If the plumbing breaks, he slashes rates immediately. The tight money cover. Warsh will use his aggressive balance sheet reduction as intellectual cover. He will argue, I'm shrinking the balance sheet to be responsible, which gives me room to cut interest rates aggressively without causing inflation. It is a perfect political hedge. Structural difference, the yield curve. Finally, the different outcome manifests in the shape of the yield curve, which changes who makes money in the economy. Powell's 3%. Achieved with a passive balance sheet, the yield curve remains relatively flat. And we do have a 2 to 10. Now I think that is like 74 basis points. Warsh's 3%, achieved with aggressive MBS sales. I thought that was an asset swap, but again, AI is not perfect, right? He cuts the overnight rate to 3% to please Trump, but floods the market with bonds, keeping the 10-year yield higher, 4.5%. This creates a steep yield curve. The winner, regional banks. KRE, I promoted that for a while, and I even have the KRE on the market outlook saying, let's watch this. They're a winner on this one if this happens. Banks borrow short, lend long. Steeper curve restores their profitability, reigniting the bank lending engine for real estate and small business. You got to be kidding me with this bird. Right beside me. Anyways, let's see. Final verdict. The difference is not the number, but the risk premium. Powell forces the market to guess every month if rate cuts will stop. Warsh provides a forward guidance commitment that the cuts are structural. This reduces volatility, encourages business to invest now rather than waiting for the data to clear. I agree with that as well. Let's take a little tour of Warsh. I watched a whole bunch of podcasts and made some notes on who he is and what he thinks, and let's go through that. Okay, I made a few notes here. Warsh, Stanford undergrad, Harvard Law. Accuses the Fed of institutional drift. I think he's right on that. Failure to satisfy its statutory remit. Well, I'd probably need more on that, but that's really all the statement that was made. Contributed to an explosion of federal spending. I can see that. You have this idea that in tough times, the government will spend a lot of money and the Fed will buy the bonds. And it did that, I think, for far too long. Coming out of the pandemic, the Fed kept buying bonds all the way to the end of just before they started raising rates. They just kept building up their balance sheet and massive deficits. This is a quote: "If the Fed is buying all these bonds, we can spend trillions." It was sort of as he was talking, saying the government is thinking, well, if the Fed is buying all these bonds, we can spend trillions. That is inflationary, he argues. That's where his hawkishness comes from, is this stuff. Outsized role and underperformance. This is an interesting quote. "Inflation is a choice. If economists were smart," I love this one. It has nothing to do with what we're talking about. It's such a great line. "If economists were smarter, they'd be physicists and mathematicians." He resigned from the Fed in 2011 when QE2 was launched, arguing this very thing, that all you're doing is enabling massive government deficits, and you're enabling demand beyond the supply of the economy, which is going to be inflationary. Duh. That's what he was saying. And he was principled enough about his belief to say, I can't be part of this, and he resigned. I mean, you have to admire him for that. Blames both the Fed and Congress for massive debt increases. The Fed, a major source of inflation through enablement, treated normal times as emergency for too long. I mean, you had rates at the zero line for a very long time, QE1, QE2, QE3. Then you had even more balance sheet building during the pandemic. Did you need QE2 and QE3? He thought no. No matter what our government does, the U.S. is an incredibly productive society. No matter what our government does, I've made that point before, that the U.S. economy is not resilient because of government, it's resilient in spite of government. Government is not helpful. If we shrink the balance sheet, interest rates can be lower because you'll have less inflationary pressure, at least demand-driven inflationary pressure. We are on the verge of a productivity boom. These are some of the thoughts that he has. So his argument really is, look, take that balance sheet and squeeze it down by $3 trillion. Yes, you'll keep the long end of the curve up. It's not going to come down, so I don't know that TLT makes a lot of sense under Warsh. Because of that, you pull that liquidity out of the market, you stop enabling government deficits. They have to go to the market to raise money, not to the Fed to raise money, so that might put some discipline into them. And with that, you will have the ability to lower rates. And if you do have a productivity boom, you can justify lower rates. If you give the banks a steeper yield curve, they'll lend more money for productive uses. I can't disagree with any of those statements. Now, mind you, I am very long ZQ, so anybody who says I'm going to lower interest rates, I got to say, yeah, it's a smart move. I kind of agree with you. So if you want to accuse me of having a bias now, I certainly do. Okay, let's see what we have week over week. We have some of the short rates. I kind of mixed on the short rates on yields all the way to the 7-year lower, but the long end of the curve, the 10, the 20, the 30, higher week over week, and higher for the year. And I think this is pretty much where he would like to keep it, and to bring the short rate down so that the 3-month to 10-year slope increases to make banks very happy to lend, because that spread will be so nice. That is 59 basis points right now. Looking at our performance for assets for the week, the KRE really liked it, up 1.77%, up 6% year to date, beating SPY, beating IWM, beating triple Qs, the KRE, and you get a nice yield in there, dollar. That did not do well this week. In fact, it did really bad until Friday. Friday recovered a little bit. The safe places to be, XLU, utilities. Utilities have a 100% track record of outperforming in contractions. So it is the safe place to be. IYR. This seems odd, given that the long end of the curve is not going to cooperate. up 0.18 on the week. XLP run to some safety. This is Staples. Had a crappy year last year. It is performing incredible this year, up 7.51% year to date. That beats tech by a factor of 5 times, 6 times. And look at that yield, 2.59%. So even if it doesn't go any further right now, you've secured a 10% return on XLP. If it just goes sideways for the rest of the year and you collect that dividend, you got a 10% return on XLP. SPY up 1.47 for the year, slightly green. IWM. Now this to me seems rather odd that if anything, IWM should have done well along with the KRE, but here we are. Up still strong for the year, 5.48%. And triple Q's kind of flat, and that sort of just ignores a lot of the volatility that happened during the weekend. TLT is the big loser on this one, 0.91 negative for the year. You're just getting paid to hold it. I don't see a gain in this one. If Warsh carries out what he wants to, keeping that long end anchored where it is so he doesn't raise mortgage rates and bringing that short rate down, steepen the curve for the banks. That's good. It's good for mortgage REITs on their liability side, maybe not so much on the asset side, but on the liability side. Any balance sheet where the liability side is heavily dependent on the short rate should benefit. TLT is the 20 to 30 year segment. We can see since the beginning of the year, pricing is lower, and it was not a good week. Looking at Fed funds futures, last week it was pricing in 48 basis points by the end of the year. Now we're 53. We'll see if we can get a few more in there, but pricing in 53. You have 2 more meetings under Powell. I seem to think you get one more cut under Powell. I think the jobs market data will give it permission to do one more cut. And one more cut's not going to change anything. So there's no risk to his legacy at this point, and it gets him one step closer to neutral, and I think he'd like to leave having engineered a soft landing, having beaten down the worst inflation in a generation, and ending almost at the neutral rate, or what the Fed believes the neutral rate is. I think as a going away present, maybe they give him one more rate cut, which means I only need one under Warsh. I think you get 50 in July. Now, with a changed strategy and a changed focus, you can have the rest of the members saying, okay, well, we're not data dependent anymore. We have a different strategic orientation. I get what we're doing. We're going to really lower the Fed balance sheet, pull liquidity out of the market. I think he might be able to convince enough people. Besides, Powell leaves. He's got 4 of the seats. 4 on the Board of Governors. 4. All right, so I think my position at this point, I would say, is as close to subjectively risk-free as you can get. I need 2 cuts in 7 meetings. Look at even going out to January 96.89, going out to April 96.89. That gives you 3.11, which is 3 to 3.25. That's still the same basis points down. I just can't see that. And you're 9 meetings away for that. And during this past week, how many companies had announced layoffs? And some of them attributed those layoffs to AI. Give it another month, then give it another month. Month after month after month, the tools that are coming out with the AI systems are just incredible. If you haven't seen Kimi K2's latest version, KIMI K2, have a look at that. Looking at real rates and break-evens, not much of a story to tell here week over week. Hard to make sense of it given the volatility. Everything last week was in the metals. My God, what a liquidation that was. And when we look at the percentages, like gold down 2.93% week over week, ignores the path. Gold was over $5,600 Thursday morning, dropped all the way, touched $4,700 on Friday. That's a $925 drop from the high it hit Thursday morning to the low on Friday. To say, oh, it's only down 2.93%, ignores it. We're going to spend some time with the metals And our spotlight company this week is a mining driller. Year-to-date, up 11.93%. Silver had an ugly Friday, down over 30%. On the week, down 20%, but still up for the year. Copper, if I say, well, it's down 0.12%, up 4.37%, you'd say, well, that was well-behaved, but copper took one hell of a round trip as well. Aluminum down 1.82%. These are your industrials. And then platinum, look at that, down 23%. Palladium down 17%. Oil up 7.53% on the week. Natural gas down 17.74%, still up 17%. Once the cold snap passes, the inventories will build rapidly because the U.S. produces just a hell of a lot of natural gas. And then, of course, not much to see in the grains this past week. Corporate spreads, year-to-date tighter. All last week tighter, but this is as of Thursday, right? We haven't seen Friday's data yet. We won't see that till Monday. MBS 0.14. If you do an asset swap between the central bank and the Treasury, then you don't have to worry about how's the Fed going to get rid of that $2.2 trillion of mortgage-backed securities. Agency and Annaly did not have good weeks, which is surprising to me because if you're going to get that short rate down, if you have more certainty on the short rate, on the liability side, that serves them well. Maybe the pricing was starting to price in some asset side enjoyment, like a lower 10-year. Now, this is at odds with Besant, who has a 3.33. One of the threes is a 3% 10-year Treasury. Warsh is sitting more around a 4.5% Treasury so that he doesn't raise mortgage rates. Mortgage rates are 6.1%. Are we going to see a 5 handle? I don't know. We're going to have to wait for Warsh to say something. Where's his acceptance speech? Maybe he doesn't want to say much. By the way, another thing that I think you can like Warsh for is in meetings last year with Trump expressed his desire to fire Powell and put Warsh in earlier. Warsh told him not to. He advised him against it. Don't you fire the Fed. So Warsh, being the institutional he is, that he is on this side, may decline to actually publicly say anything until Powell's term is done. He may decline to do that. He may even decline to take Miran's seat. We'll see. I mean, if he does all of that, you got to say, well, that is one principled man. You got to like that. But he may do that, so we may not actually hear anything. And that crow is right there. He's here for his morning bath. I have a crow that lands by my pool. He hops on the top stair, and he takes his bath every morning and decides to scream at everybody that looks at him. So, yeah, let's watch for that 5 handle. Mortgage apps last week down 8.5%. Case-Shiller year over year up 1.4, but month over month 0. We have our next Fed meeting March 18th, and on that one we're going to get summary of economic projections. Right now the weight is on 0, 84.7%. This is should be a 5.3%. Powell's last stand. Last week there was a 97% probability of 0 or 1 cut. This week pretty much the same thing, 0 or 1 cut. Warsh's first stand. Last week there was about a 59% probability of at least 1 rate cut. That is now 67.5. I believe that should approach 100%. So I think ZQ has some repricing to do this week, but I believe that should be closer to 100. Reverse repos end of month always does this, and on Monday when we get the data for Monday's reverse repo sometime in the afternoon, you'll see that drops right back down. Repos are at 0. TGA 952 billion. What are they doing? Maybe they're getting ready for all the refunds that they gotta give out. Reserves 2.88. When the TGA increases, reserves decrease. This will be interesting to watch under Warsh because he wants to leave the ample reserves regime. So what is going to happen to reserves? That's going to have to shrink dramatically. By the way, the shutdown was averted, not by closing on Friday, but later that day there was a vote, and I think some partial shutdown started because they won't actually clear that till Monday. So I think some people for the weekend who are off on the weekend aren't getting paid for the weekend. Okay, let's look at our economic calendar for next week. Another big week next week. We have over 100 companies in the S&P 500 reporting earnings, and it's a jobs week. And ISM. Monday we get ISM manufacturing PMIs. Tuesday we get JOLTS. Yes, it is a jobs week. Barkin is speaking. Some of the Fed speak this week. We have Bostic speaking as well. I'm sure they'll all give a nod to the new Fed chair and see what they have to say. Let's see if their tone changes based on the expectation from Warsh. I'm sure over the next couple of months, Warsh will probably want to meet with everybody. That's the incoming Fed chair. That's what he's going to do, just to meet and greet, shake hands. Here's my vision. What's your vision? Wednesday, ISM Services PMI. You have the Treasury refunding announcement, ADP employment change. There's a lot going on here. And Thursday, not much going on. You get initial jobless claims. We'll get challenger job cuts for January. The announced job cuts. There's been quite a few. So this will be an interesting number. Bostic is talking again, but Bostic is on his way out, so I don't know that it matters. And then Friday, you got jobs on both sides of the border, Canadian jobs and American jobs. And then, of course, Michigan consumer sentiment. Who else do we have here? Looking for all the Fed speakers. I don't know if they're... totally missed that one. Mexican interest rate decision coming up. Let's look at ADP. What was the consensus? 40,000 on the consensus for ADP. That is low. Let's see if it continues on with this. Actually, you know what's going to be interesting? Friday, the jobs report. Not so much the number, but let's see what the revision was to last month. Because Powell did specify that, saying we saw a rebound in the labor market, it looks strong, but then completely ignored his comment from the meeting before, saying we believe they're overstated by 60,000, which means last month would have been negative jobs. But he didn't say anything about that. He just talked about the headline number. Let's watch the revisions for Friday to see what happens to December. And that is our economic calendar. All right, SPY. Hit an all-time high last week, January 27th, 697.16, but the small caps did not come along. Still holding the January 22nd all-time highs. We finished where 691.36, down from 697. We're not that far down. The 50, the 100, and the 200-day moving average all below where we are. 683 at the 50, 676 to the 100. You break those. Our next bounce would be, our next line of support would be all the way to 641 on the moving average. 22 and a half times, or 22 and a quarter times forward earnings, still sort of richly valued. Last week was 22.17. You have volatility that has come back. We ended Friday 13.9, but it was an ugly day all the way around, especially if you were in high beta stocks. Especially if you were in game stocks. Google's Genie making a mockery of you on Friday. And metals. 128 companies reporting this coming week. So let's have a look at them. We'll get that out of the way before we spend time with the metals space. And I got a lot there for you. Okay, let's look at some idiosyncratic risk events this week for earnings. Disney leading off on Monday morning along with Pepsi. Tyson Foods as well. Hang on, Tyson. Yeah, Tyson's 8:30. You would have had to be, if you knew earnings play, you would have had to be on that Friday, but I don't think anyone was paying attention to earnings on Friday by the close. I think everyone was just saying, please close, done. After the bell, Palantir. That's had quite the pullback over the last week. All the cybersecurity has been weak, uncharacteristically weak. Now, there is some thinking here, that if AI is going to rewrite software, that cybersecurity is really just software, but it's not. Cybersecurity is about the size of the crowd that you have, because there are millions of attacks each day, but there are hundreds of millions of normal logins each day. You need a system that can tell the difference between an attack and a normal login. For that, you need big crowd sizes. So you can write, and I made this example before, you can write the software for Facebook. That doesn't mean that you can compete with Facebook. You need the crowd. So cybersecurity, these companies like CrowdStrike and Palo Alto win because they have the crowd. You're not just going to write software for that. So I think unfairly they have been sold off. Now, if you want to accuse me of being biased, you can, because I do have a position in it, but I have a position in it because I believe that it was unfairly sold off. But yes, I am talking my book. Palantir. I have no position in Palantir. Teradyne as well. Teradyne has a small humanoid robot division growing in there. Let's look at Tuesday morning. We have all the way down to Willis Towers Watson. PayPal. Pfizer and Merck are reporting. Archer Daniels Midland, Illinois Toolworks, and after the bell, I think we have some exciting ones here. AMD is the big one after the bell. Electronic Arts. Let's see. Supermicro. Does anyone pay attention to Supermicro anymore? Take-Two will be interesting, not because I follow it or do anything with Take-Two, but Google's announcement of Genie on Friday really shook the game sector. Take-Two got punished. So some analyst somewhere is going to ask the question. So it may be interesting to listen to the commentary. I think they'll probably have to address it if they're giving guidance, or to listen to the Q&A. I think that'll be interesting to listen to, not for an investment in Take-Two, but what are they going to say? Chipotle Mexican Grill. They have not been doing well lately. They're expected to report 24 cents. Versus 25 cents. We go to Wednesday morning. Yum Brands. We have Aptiv. I have a position in Aptiv. There was another big one here that was reporting on... there it is right there in the morning. Uber. I have a 5,000 share position on Uber. I had a collar on it, but the collar was well in the money, so I took the collar off and I just kept my position. Let's see what happens. Did I miss anything interesting here? Going into the evening, 4 o'clock. Where's 4 o'clock? Starts with Aflac, Allstate, Avalon Bay. That's a big REIT company. Essex Properties, another REIT company. Alphabet. You have Google reporting. You have Qualcomm reporting. There's another REIT, Mid-American Apartment. Going into Thursday morning. Thursday morning ends with Xcel Energy. Who do we have? Ares, Bristol Myers, Cardinal Health. Ooh, let's listen to their guidance based on the beating that these companies had last week. Estee Lauder. By the way, a bit of trivia. Kevin Warsh's stepfather is a Lauder. Is one of the heirs of Estee Lauder, is one of these guys. What else have we got here that's interesting? Amazon. After the bell on Thursday, Amazon. More REITs, Digital Realty, Equity Residential. And we have another cybersecurity here, Fortinet. I do have a position in Fortinet. Anything under 80 I think is interesting on that one. And... let's go to Friday. Friday, I think, is rather boring. I have nothing in any of these. And that is our calendar. All right, time for the exciting stuff. I'm going to go through 4 metals. Copper, silver, gold, and platinum. And we'll look at just the violence of the move from Thursday morning to Friday night. We have to think that in all of this, there's a couple of funds out there that just had a bad day. What we're not going to hear of are the millions of retail accounts that were chasing this that probably got stopped out very quickly on Friday, if not got wiped out, because that's the nature of derivatives, right? Derivatives don't create value or destroy value. They simply transfer value. From the long side to the short, from the short to the long. Every contract has a long side, every contract has a short side at any given time. Half the market is short gold. Half the market is short copper. Half the market is long silver at any given time. What I have on the screen is a one-year copper price. We can see some key events here. This was the 50% tariff on copper coming into the U.S. Up the price went, and oh, no, we're only kidding, down the price went. Try to keep up. And then we have a recovery of the longer-term trend on the price of copper. If you extend this out, you get to 540. And, of course, you can see that it leaves its support trend and it keeps bouncing off it. And then it just decided to go parabolic at the very end. These kind of moves never sustain themselves. It's not a question of if they'll break. It's only a question of when they'll break, and they broke on Friday. Question we ask now is there any value in trying to grab this falling knife? Is it a falling knife, or is this an opportunity? I sold 573 puts on Friday, and I got 0.2129 for that, which would give me an average put price of about 552, 551, 552. Look at the moving averages here. The 50 days 560, the 100 days 531, the 200 days 518. Let's have a look at the anatomy of these 2 days. Copper was moving along nicely between $5.90 and $6. Thursday AM, it decided to just take off to the moon all the way to $6.60. It peaked there, and then it just by Friday PM hit a low here of $5.75, ended in the $5.90s. Pretty much, as you can see, where it was. All of this just boom, gone. So I looked last week when you had this going on Thursday. I said, well, what's going on here? You know, it was running up with all the other metals, but copper's different. It's not a precious metal. It's an industrial metal. You wouldn't use it as a store of value. It is primarily an industrial metal. Glencore had reported 2025 output down 11%. Blaming low ore grades and water issues, and their 2026 forecast mid-range 840,000 tons, down from 930. In a market where you already have a structural deficit of copper, it just widened. Southern Copper saying the same thing, but not really giving any numbers, just citing, lower grades, water issues, we see that too. But demand only set to increase here. Electrification, AI and digitization, decarbonization. Forecast here by 2020, a cumulative 10 million ton shortfall by 2040. That's cumulative. That's not a 10 million ton shortfall in 2040. It's just cumulative over all the years to get there. So something has to be done. Let's look at some price targets. Reuters, average of 31 analysts for 2026, average price 11,975 a ton, translates to 543 a pound. I think that's about right. The important thing are the levels. You know, if you go back 2 years, your levels were sitting around $3.75 to $4. All right, over the last year, your levels were somewhere between $4 and about $5.50. This year, your levels will be probably around $5.50 plus. So all of this encourages production, encourages exploration. So if the price of copper goes up over a period of a couple of months, that does not encourage exploration. If the belief is that the price will rise to that level and be sustained there for a period of time, that encourages exploration. Mining companies typically don't do their own drilling. Some opportunities coming up. And that is our company. Our Spotlight company is the world's largest mining driller, Freeport being one of their customers. So I think the longer term trend for copper is still in place. This was just nonsense, but the excess of this has to be wiped out. So it wouldn't surprise me if you still had some sell-offs going into Sunday night and Monday, meet margin calls, liquidations, depending on what the market does. If the market's red, I think this continues on. Before it decides to find a home, you might actually blow past 540 on the downside. But if I had to bet on 6 o'clock, do we open green or open red on copper? I would say probably open red. But I'd be comfortable adding to this position as it is drifting down. I would look for any option that's in around 22 to 23 cents. So let's say it drops another 15 cents and I go to the 541s and I see 22 cents. Well, that's pretty much where I'm going to grab it. Why 22 cents? I don't know. I locked onto that number, and that's just the number in my head that I like. Okay, let's head over to gold. Gold had the same thing. Look at the very end of the chart over here, that big red line down. Gold was pretty violent. Thursday AM hit a high of 56.25. By Friday PM, the low point was 4,700. Look at that, a $925 swing from the highest to the lowest point. We finished somewhere around, I think that's 4,900 on this one. And there are two lines here. First support line gets us to about September, and then we sort of had a move upwards from September. When you draw these kind of lines, these are support lines. They're called speed lines, and if it starts moving up higher, you can draw another speed line, and then another speed line. Gives you an idea of the momentum behind it. So we have two numbers, 3750 and 4500. I think the 4500 is the more realistic number. We have the 50, the 100, and the 200-day moving average. The 200-day moving average is closer to the slower speed line, with the 50 and 100 both below 45, so 44, 43. We got to a low of 47 before there was a bounce off of that. Let's see what happens, but gold has the very real potential of, I heard one analyst saying, revisiting 3,800, which would put it down to the lower speed line. And 3,800 is your 200-day moving average, so we still have some risk in here. Same thing with copper. Grades are dropping. Supply expected to peak in 2026 and then decline. Lower grades. The forecast here, 16 mines expected to produce operating losses because the grade in the ore is so low that even with the copper or the gold price where it is today, by the time they process that low-grade ore, they're not going to make any money. 16 mines. Total demand, 4,800 to 5,000 tons. Mine supply, 3,600 tons. Recycling is 13. That gets you to 49, which is the mid part of the range. But remember, supply is expected to peak this year and then decline. So we're forecasting deficits on a going forward basis. So we have a very tight balance that is going to lean towards deficit. Tier 1 supply limited. Actually, the word elusive was being used on this one by an analyst. The belief is that most of the Tier 1 mines have been found. There are no more Tier 1 mines, which means the price of gold is simply going to have to go up if you want to buy gold. Right now, looking at seniors and juniors, seniors are high grading. Means they're favoring ore that has greater than 5 grams per ton. Juniors are looking for high-grade satellite zones. So you have a mine that's productive, and then in around, let's say you have a large region like that, and you have a productive mine over here. The unclaimed areas, these are called satellite there, more active drilling in these sites. Here is the issue for miners, especially the seniors. There's been some discussion for a while. How come gold mines aren't coming along? The price of gold is going up. How come gold miners are not coming along? It's not a matter of the price of the product that you produce. It's also a matter of your balance sheet. You have to add to reserves, or at least keep reserves constant. So you have a certain amount of reserves, and if you're high grading, you're taking as much of these reserves out as you can. If you're not adding to your reserves on your balance sheet are shrinking, your life of mine is contracting, and a mine has zero terminal value. Once you get to zero reserves, you got zero terminal value. In fact, you have negative terminal value because you have a whole bunch of reclamation costs. So what a mine has to do is it has to add to reserves at least the pace that it depletes those reserves. That requires drilling. If you have the seniors that are high grading, to add to their reserves, they're going to have to increase their drilling budget. Starting to see where we're going here, right? Juniors are looking for high-grade satellite zones. If you're doing that, you need drillers because the juniors don't operate their own drilling rigs. Most of the seniors, only a very few of the very large one, will operate their own drilling rigs for only specific things. But most of them outsource their drilling to drilling companies. Let's look at some price targets. JP Morgan for 2026, 5,000 an ounce, UBS 6,200, Goldman Sachs 54, Morgan Stanley 47. This is year-end 2026. And mines are saying they're viable. At these prices, viable cutoffs drop to 0.8 to 1 gram per ton versus 1.5 grams per ton. So gold, I would be more willing to step in front of copper than to step in front of gold. But at some point, if we do hit that 200-day moving average, I will look at selling puts on the gold contract. All right, let's get to what retail probably thinks is the more interesting one, silver. This is a one-year chart. Look how pronounced that sell-off is. One red arrow straight down because you started increasing nicely over here and then decided, nope, let's get it all priced in now, and anything that goes parabolic always comes down. So here's the 50, the 100, and the 200-day moving average. The 200-day is all the way down at $49. The 50-day, which is the highest, is sitting at $73.38. We finished somewhere around $80. Silver has a bit of a problem. 70% of the supply is a byproduct, meaning that you're mining for lead, zinc, copper, and you're going to get silver out of the ground. Silver is not the deciding factor about what to do. It's your primary metal that is your deciding factor, and you're going to produce silver. So it's rather insensitive to price. So if there is a deficit and the price goes up, you really got about 30% of the supply that will respond to those price signals. The rest of the market will say, look, we get the silver when we get the silver, period. The same thing on the way down. If the other metals are still being mined, we're going to put silver on the market no matter what the price is because we get silver. They're not going to suddenly say, well, we're not mining silver. You don't have a choice. You pull up a ton of ore, and there's a number of different metals in there. You're going to get them out. You're there for the zinc. And guess what? You're going to get silver. 2026 production, flat. And that's been for 5 years now. Mine supplying 830 to 850 million ounces, recycling about 180 million ounces. Inventories right now are low to critical. And demand, you have industrial, which makes up a large part of it, 60%. Investment in jewelry making up the rest. The deficit between the two sources, about 100 million ounces. And inventories used to be much higher, so flat supply with a 100 million ounce deficit didn't matter too much because you could work down inventories. But inventories now are low to critical. On the industrial side, solar PV, 200 million ounces, a little bit more than 200 million ounces per year. 29% of industrial output comes from solar, and the compounded annual growth rate expected about 17% through to 2030. EVs take about 25 to 50 grams of silver per EV, and EV growth is growing. Look at the 1 week chart on this thing. On Thursday AM, 121.78, you have that peak right there, and then it didn't take long to drop, tried to recover, and then straight down, hit all the way a low of 74. That is a big move on copper, almost a $50 move on copper from Thursday AM to Friday, the Friday low, the peak to the trough, and then ending somewhere, I think, around 82 and change. JP Morgan, 75 to 100 per ounce. Citi, 150. I don't know how much of that is the fact that they see the price going up, so they better raise their price target. UBS, 75. Given that it is in structural decline, this sideways move didn't make a lot of sense. As inventories were working down to critical levels, you had to see some price increase. Here we are. If you follow this line through, you're somewhere between $55 and $60. We're sitting at 80. Wouldn't surprise me if silver reached that level and then continued to just climb for a while on this white line, or at least bouncing off this. But I think these parabolic moves, you don't get to do that 2 and 3 times. Usually when it goes parabolic, it goes straight up and then it comes straight down. If you pull up a chart of metals, gold, silver, for the last 30 years, every time you saw it do this kind of stuff, it always came right back down. Then you'd see it do this and then go up and come right back down. These are very short-lived periods. This will be in the history books as that period as well. I don't know that I'd be stepping in on silver. Silver to me is rather uninteresting. I think if I had to bet and I could only pick one metal and I had to bet, I think you know what it is. It's going to be copper. Because it has a very clear industrial application that you can see and that's real and it's hard to argue with. And there are no more really big copper mines, and the copper mines that are producing out there are all lowering their grades. So there's going to have to be more exploration, but you're going to get to harder to reach areas with lower grade. Those are the drillers. The drillers will make money regardless of what the grade is, but lower grade ore, you're going to have higher prices, and there really isn't much of a substitute for a lot of copper that's being used. Okay, we'll end with platinum. Also did not have a good day. Here is the line of support that we can draw, and moving along nicely along its line of support for some good fundamental reasons, and then just decided to go along for the ride. Your 50, your 100, and your 200-day moving average. Your 200 down at 1550. The white line extends to 1700. Mine output 6 to 6.2 million ounces per year. It's been flat to about negative 2% per year for a while. South Africa, 75% of global output. Labor strikes, power outages, water shortages. Recycling accounts for about 2.2 million ounces. Automotive uses 3.9 million ounces per year. The more hybrids you make, the more platinum you need. Hybrids favor platinum. Industrial and jewelry, about 2.8 million ounces per year. And investment, really small, 1.6 million. So there is a forecasted deficit, 480 million to 700 million ounces. This is the third consecutive year. However, the price projections don't seem that favorable. Reuters, 1,500 to 1,800. You're sitting right now at 2178. That gives it some downside. Palladium, even worse, 1150 to 1350. Deficit of 180,000 ounces. Expected to be balanced by 2027. And palladium is at $1,700 an ounce. So platinum and palladium, they're harder to play, less liquidity. I don't know that I would expect too much excitement on these. I think the big game going forward is going to be played in copper and gold, with silver probably finding a home somewhere between the $60 to $75 range. Look at how bad of a Friday it had. Thursday, this is Monday actually. Monday it didn't go along for Thursday. Thursday didn't do too much. Monday it hit its peak at 29.25 Monday AM. By Friday PM, the low, it printed a low of 1980. That's $1,000 move. 33% move in 1 week. Oof. Let's have a look at a driller. Okay, our spotlight company this week, Canadian-based company. Actually, they're global, but offices in Canada. Major Drilling, largest drilling company in the world. You would think that they'd be bigger than a market cap of $1.23 billion, but the market size of drilling altogether is about 5 to 7 billion globally. It's not really that big. Major Drilling right now probably will do close to $1 billion this year, which makes them about 20% of the market. 52-week range as low as $6.51, as high as $17. Q2 ended October 31st. They had beat the expectation for EPS by 2%, and they beat the revenue expectation by 1.87%. Revenue drivers, seniors, is their CapEx. The more CapEx they spend on exploration and production, that is what drives the drillers. Much like the drillers in the oil sector are not driven by the commodity price, they're driven by the size of the CapEx budgets from the oil exploration companies. 92% of their exposure, their customer base, is to the seniors. For juniors, it's the level of financing juniors get. They raise equity financing, and then they hire these drilling companies to say, okay, we got the money, you go drill now. Only 8%, because huge credit risk with the juniors. So the revenue driver is not necessarily commodity prices. The commodity prices drive the financing for juniors and the CapEx for seniors, which then drive the revenue for Major Drilling. So Watching the commodity price from day to day isn't going to help you. You got to look at how much the miners are willing to spend. You look at their production, you look at their ore grade for the majors, and again, they have to replace those reserves on their balance sheet. Otherwise, their stock price isn't going to go along, because every miner's terminal value, every mine's terminal value is zero. So you have to continually add to your reserves. By commodity, their exposure: gold 39%, copper 31%. So 70% of their drilling is in pursuit of gold deposits or copper deposits. New discoveries in precious, base, and critical minerals increasingly are in remote regions and greater depths. That lends itself to specialized drilling. Major Drilling has 707 rigs spread across specialized, conventional, and underground. There's not a lot of money in conventional, so it's not a primary focus. Low barriers to entry, very fragmented. Specialized, higher rates, better margins. They focus here: deep hole, directional, remote locations, high altitude, and underground. Here you have much more stable revenue, especially in the production side. So exploration, because you need exploration to maintain your mine life. If you've got a life of mine of 12 years and you're pulling out 1/12 of the reserves, you're going to have to try to find a way to replace those reserves or your future value. Keep in mind, again, the terminal value is zero, so the future value of your cash flows just decreases each year with depletion. Mine has to not only produce its output but grow its reserves at the same time. So you have production drilling to produce the output, and you have exploration drilling to grow its reserves. And when you look at gold mining companies that are high grading to take advantage of the high price, they are depleting their reserves faster than they normally would. They're shrinking their life of mine. They're going to have to use the extra money in their capex budget for more exploration drilling. And again, up here, new discoveries are increasingly in remote regions and greater depths. Specialized drilling, that is a big focus for this company. Production, percussive and long-hole drilling. Most mining companies do not maintain dedicated drilling capacity. So most mining companies, the really large ones, will have some drilling capacity, but it's expensive to keep online because you have to carry it no matter what your level of exploration is. So usually this is farmed out to drilling companies. And Major Drilling is the largest. I always say, if you're looking at a space, go for the largest company. We're going to have a look at their a few more bits of information about the industry itself. Then we're going to have a look at their Q2 presentation. Okay, as I said on the previous screen, the global market size. It's a small market, 5 billion to 7 billion. The top three companies in this sector have about 15-20% share. Largest markets: North America, Australia, and Africa. It's important to understand the commodity super cycle, a 30-year cycle, 15 boom years, 15 bust years. The last peak figures around 2008, 2009. As the peak is approaching, utilization rates increase, and if your utilization rates are increasing, that drives pricing power. Major Drilling says that anything over 50% utilization really starts to drive pricing power. Margins expand and fleet values appreciate. We figure we bottom 15 years, 23, 24, and then we start the next upswing, which will peak roughly 2038, 2039 if we follow these super cycles. And if we look back in the data, there's a lot of evidence to suggest that the capex cycle does follow these long cycles. Seniors, mid-tiers, and juniors. Seniors, usually drilling companies enter into multi-year master service agreements, which set out a whole bunch of terms, but not the work to be done, such that if the company calls the drilling company, say, okay, well, we need this done. Most of the terms are negotiated under the master service agreement. It's just the nature of the work after. Relatively stable demand, lower revenue volatility, but reduced upside. Mid-tier, similar, but more concentrated and geographical focus. And juniors, a lot more upside, but huge credit risk. So Major Drilling talks about the juniors and says whenever we do work with juniors, we get like 40% of our money up front before we even start drilling. Whereas with the majors, they don't mind billing on net 30, net 60, but with the juniors, it's like you got to pay me up front. Lot more cyclical as well. Keep in mind, this is driven by CapEx, right? And this is driven by financings. So the best headwinds or tailwinds for a drilling company, a mining drilling company, is when you start to see junior miners raising a lot of money, like more money being raised, more financings being done for juniors, because that money is exploration drilling. And a junior mining company has a couple of geologists, but no drilling rigs. It's all outsourced. And for the large mining companies, you start seeing lower ore grades. You start seeing production outweighing increases in reserves. They're going to have to massively increase their exploration drilling. Okay, let's have a look at its Q2 income statement. Last week, we looked at a company that was more of a balance sheet company. Sunrun. This is a income statement company. The revenue is important. Total revenue, 244 million. Last year was 189, but this does include the revenues from an acquisition in South America. Let's look at their expenses. We got direct costs 195, and there's your gross profit 48. It is worth breaking down these expenses. Largest expense for drillers is labor. Finding qualified drillers is brutally hard to do, and they make a lot of money. So usually employee salaries and benefits end up being the biggest part of their expenses. 35% typically is 40 to 50. Largest component of their expense, 40 to 50%. They're coming in at 35%. That's not bad. Materials are the second largest, and we see here materials, labor and materials being the two big ones, consumables and external costs, 34.5%. And their general and administrative, quite low, 8.9%. The year before, 9.6%. The higher the revenue goes, these things don't change. So you have this operating leverage. A certain amount of your costs are fixed. Your general administrative are primarily fixed. Employee salaries and benefits mostly fixed. Even in downturns, you're not going to lay off your more experienced drillers because you don't want them going anywhere. They're hard to find, so you keep them. So there is a sort of a limit in low utilization rate environments of how many of your key employees you're going to let go. You'll continue to pay them only because you'll never find them again. So I say mostly fixed. Your materials and consumables, these are variables. Depreciation tends to be very fixed. They follow component depreciation for their equipment. It's anywhere from 3 to 15 years using straight line. Residual values 0 to 15%. Rigs are probably closer to 15% with 15 years. And the components to the rigs anywhere from 3 on up. Typical lives are 7 to 15. They're 3 to 15 across their equipment. They're not out of line. It's not as if they're saying we're using 25 years and using a lower depreciation number. They're in line with industry average. Useful lives will extend beyond 15 years. So you depreciate over 15 years, but you can get up to 25 years out of a rig. Maintenance costs go straight up. And maintenance costs are a function of the age of the equipment, the utilization rate, and the maintenance philosophy of the company. Some companies will defer maintenance for as long as they can to really boost their margins, keep that utilization rate high. So revenues, that varies with utilization, and Major Drilling says anything above 50% utilization, they start getting pricing power. Let's look at their, get all the way down to earnings per share. 2025, you have 17 cents. The quarter before, 2024, 22 cents. The year before, what happened? Freeport. This happened right at the end of their quarter. The Grasberg mine got shut down. I think anybody who follows Freeburg knows that. Freeport, come on, man, knows that. So they took a hit there. Otherwise, it would have been a better performance. Let's also have a look at the historical summary, 2015 to 2025, just to give you an idea of the growth rate and their margins. Fairly stable. 2020 to 2022, like 2021, 2022, were particularly good years because money was almost free, and juniors raised a lot of money during that period of time. So that was sort of like an excess. So it's a bit of an outlier, but we'll see that in the trend. So we'll look at the historical summary, and then we'll finish up with their investor presentation. Okay, here's our historical summary to the end of fiscal year 2025. We are at the end of the second quarter of fiscal 2026. January 31st, yesterday, was the end of their Q3. So we should be getting results sometime late February, beginning of March. So let's have a look at their revenue. They break it down to three regions: Canada, US, South and Central America, Australia, Asia, and Africa. And 2015, 306 million, growth all the way to 728 million. The excess period, you could see 2023, 2024. In 2022, 2023, 2024, sort of was a lot of a lot of money raised by juniors. This was a good period for them. The percentage of revenue, gross profit, 21%, and we can see we're sitting up around 25% now. It did peak around 30%. You had 27% here, 30%, 28%, which gives you some idea of the level of operating leverage that they have. They did claim that 2025 was a slower year than they thought it would be in terms of CapEx and financing. However, they did note in a recent interview with the CEO that that financing for juniors increased into the end of the year. And with price levels, I think, that are going to be elevated on on copper and gold over last year, that is going to encourage more exploration and more drilling. Let's go down to their EBITDA per share, 17 cents in 2015. Look at the increase: 139, 174, 146, 124, which is again 2025. They're claiming was a little bit weak. We're already sitting at, I think, a run rate should hit over 900 million this year in revenue for 2026. If the second half of 2026 is like the first half of 2026, close to 900 million, sitting here at 728 million. Q3 is normally the weakest quarter for major drilling because Q3 includes the Christmas holiday. So there's usually a lot of shutdowns during that period of time. So it ends up being their weakest quarter. Let's have a look at their presentation. One of the things I strongly recommend when you're getting to know a company, start with their investor presentation. Don't start with the 10Q or the 10K. Oftentimes in the investor presentation, you'll get information that's just not available in the quarterly or annual reports. And you'll get information over longer periods of time. So it gives you a better picture very quickly of what's going on. For example, in our presentation here that we'll look at, we're going to get a breakdown of their drilling rigs in terms of how many are dedicated towards specialized versus underground versus conventional, and the utilization rates. If you look at their 2025 annual report, their Q1, their Q2 reports, search for utilization. You're not going to find it anywhere. Nowhere in those reports do they give you a breakdown of what their rigs are doing in terms of the type of drilling or the utilization rate. But you get it in the presentation. So oftentimes you can do a lot better with the investor presentation as your starting point. So let's have a run through this. It's only 24 pages long, and it's given to you in a way that's digestible as opposed to reading through lines and lines of stuff. It gives you a great place to start asking questions and making your notes. A low-risk exposure to the mining space, diversification by commodity. And we see 70%, as we've already, we'll see it in here, 70% is gold and copper. By commodity, customer base, and geography. Strong balance sheet, liquidity, stable operations through life cycle of mine. Substantial upside. Commodity price strength expected to lead to growing levels of spending by seniors. That's what drives their performance, is the CapEx. Increasing number of junior financings expected to lead to additional demand. That is all exploration. And strong operational leverage from our existing fleet. Here's drilling revenue by customer. Look at the seniors, 92%. Juniors, only 8%. So you do have some optionality for the upside. By commodity, gold, 39%, copper, 31%, iron ore, 10%, and then you have others as well. 92% sourced from seniors, intermediate mining companies providing revenue stability, and they give you some of the names of the companies that they deal with here. No one project represents more than 10% of total revenue. Geographical risk, you see there's North America, we see South America. This blue area, they bought a company called Explomin. I'm saying it right, Explomin. For some reason I think there's another in there, Explomin. So they have huge access to copper mining up here. There is Indonesia, there's the Grasberg mine, so you can see right away, well, if they have exposure to the Grasberg mine, they're offline right now. 20 registered countries, 6 continents, over 6,000 employees, 707 drilling rigs, 149 million liquidity, 14.3 million net cash position. That means you take all your cash, you pay off all your debt, you still have 14.3 million left, so they are net cash after debt. Moving on. This is kind of neat. Drilling from discovery through production gives you a nice view of where the different drilling techniques are used. Early stage exploration, RC and core drilling. This is reverse circulation. Discovery stage, the feasibility stage, construction, ramp up, steady state operations. This is production. So they engage in full life of mine from early stage exploration to steady state operations. Outlook for 2026, record gold prices above 4,500 level. Increased cash flow generation, stronger producer balance sheets coupled with depleted reserve bases. If you have depleted reserves, what's happening to the value of your mining operations? They're decreasing because, again, zero terminal value unless you replace those reserves. So that is a leading indicator for increased capital expenditure towards exploration, because you got to replace those depleted reserves. Copper price is near an all-time high. World accelerates its efforts towards decarbonization, electrification. Demand for critical minerals also continues to increase. The U.S. has recently placed copper on its list of critical minerals. New mineral deposits to be discovered in areas that are increasingly difficult to access, requiring more specialized drilling. Equity capital raises also beginning to increase, expecting strength in junior equity financing to continue, supported by gold prices. This is a neat little chart. This is why I like these investor presentations. Here is the gold price. You can see its movement here, and here is financing, total transaction value of financings by juniors. Here we have gold prices sort of going into a bit of a lull, and look what happens to financing. Really follows along. There's gold prices that are shooting up, and you see financing. This is the last 12 months. This is 2024. This is the last 12 months, 34.9, really starting to shoot up. The last time this company hit a high was in around the last peak of the commodity supercycle, 2006, 2007, hit $20 a share on a much lower rig count than it has now, and it hit $20 a share. The rig count now is much higher than it was, and we're just starting this super cycle where CapEx is going to have to increase, and we're seeing that equity raises are also beginning to increase as well. Gold continues to set new record highs, exceeding 4,800 an ounce in January. 4,800 an ounce in January. And this was written in January, exceeding 4,800 an ounce in January. Now, a little while later, it broke 5,600 all the way back down to 49. But a disconnect between gold price and junior financings persist. Number and size of junior financings has continued to increase over the last several months, with this momentum expected to continue as the gold prices continue to increase. Increasing drilling demand from seniors and juniors expected to continue to soak up drill rig availability across the sector. Exploration budgets remain well below the prior peak. This was the prior peak. It peaked 2011, 2012. Critical cyclical upturn. There's the global financial crisis. Here's the cyclical downturn. Here's the revenues. Look how their revenues, this is the exploration budget, and the red line is the revenues. Look how well that tracks. Now here are the revenues that are going up. Even though the exploration budgets haven't gone up, their revenues have increased since 2021. So you start getting a move up in this for CapEx of the seniors, along with increased junior financings, right? Operational leverage. Here's their rig count, 707. Specialized is the most profitable, followed by underground. Conventional, specialized 310 rigs. Most of their rigs, over 50%, over 50%. Most of their rigs, I should say, are in specialized and underground, over 50% for them combined. Conventional, the lowest, 160. Again, it's not a lot of money in there. It's lower margin, lower revenue, but if you got the rigs, you may as well use them. And we get their utilization rates, total 51%. If their demand increases and their utilization starts pushing 55, 60%, that starts to give them pricing power at the same time. So now they're getting more per meter drilled or more per hour of operation. So that is what operational leverage is. Existing fleet capacity, 49% of existing fleet capacity. So they're not going to need a lot of CapEx as their demand for their services ramp up. Optimal levels of inventory and consumables, retention of experienced crews. You never get rid of that, right? You keep those people. CapEx spend, fleet modernization through downturn. G&A and infrastructure already in place. As revenues increase, no substantial increase in G&A or CapEx required. Read that again. As revenues increase, no substantial increase in G&A or CapEx required. Huge operational leverage. Anything over 50%, they claim, gives them pricing power. They're sitting at 51. Junior financings are increasing. Seniors have to drill to add to their reserves. I think if you're going to be in the metal space, I think you need exposure to copper. You need exposure to gold. Where in the value chain do I want to be? I certainly want a position here. I should disclose, I do have a position in MDI. Normally during the week when I'm looking at something and I start investigating, I think this is not bad, I'll buy something. And as I start exploring it even more and looking at what's going on, I think this is pretty good, I'll buy more. So by Friday, I think I had 4,000 shares and 50 puts, 50 of the $17 puts, and 4,000 shares. It's a Canadian listed company. So I think the shares ended somewhere around 15 Canadian, which I think is around, given the exchange rate now, around 11 US. Reutilization rates, you can see their gross margins, just giving you an idea of their operational leverage rate. As their utilization rate drops, their gross margins drop. As utilizations increase, their gross margins increase. So they're at 51%. So as this utilization rate increases, their gross margins increase. They have ownership of some of these companies. They bought, I think, for $15 million. It's a private company. They bought a certain amount of ownership. I didn't go too deep into it, but it does give them imaging and analytics. Capital structure. Closing price January 20th, $14.39. 52-week trading range, $6.51 to $14.41. Shares outstanding, 82.1. We're going to see that is set to decrease. Market cap, 1.18. Average daily volume, 315,000. It is low on the daily volume. So you're not going to get large cap funds that are piling into this, driving the price up. It doesn't have the capacity. This is more than likely in any funds, it's going to be held in small cap or mid cap. But it just doesn't have the capacity. It has the number of shares. It has 82 million, but with 315,000 per day, you get any volume in here, it's really going to move the price. They do have analyst coverage. I think 5 different analysts cover this. We don't need to talk about this. Increasing number of financing. Total dollars raised in the mining sector on the TSX and TSXV up 27% year to date as October 31st. Pace of financing has continued to build momentum heading into the end of the calendar year 2025. There's a management team. Talk about their specialized drilling. We've already seen some of their financial overviews. Already seen that. I think that takes us to the end of it. So that is major drilling. I forgot one thing. I don't know why I didn't see it in the presentation. It should have been somewhere. I probably passed right over it. They have a share buyback authorization from the board to buy back up to 5% of their outstanding shares. That's why I said their share count, 82 million, expected to decrease. 5% is what, 2.1 million? They can buy up to 2.1 million shares of their stock back. There. Now I'm done.